Alright, I wanted to just show some behavior here. This is the SPY, and underneath that I have the S&P and NASDAQ tick, along with some exchange S&P volume and more volume. All I'm going to do is just go over this behavior, and it's really I don't want to say simple, but whatever. I don't know what to call it. So here you have your climax. Here you have your change of behavior. You have shit in the middle and a spring right here. All right. So the other thing to all right. Anyway, so it's climax, change of behavior. Somewhere here. Oh, there it is. The lack of supply. Right there, and a confirmation higher high up here. If you have all these four elements, you can have a big move. Not a move, but you have all the elements for a trend. Meaning this is the shift. This is how a trend is manufactured. This is how a trend is created. This is how the trend is I don't know what else to say. This is what happens. I mean, this is the whole point of Wyckoff. This really is the whole point of Wyckoff. This is the essence of the turning point. So those behaviors are said, you have a confirmation, but understand that markets are not that easy. So what happens is it can continue to go higher, but it can also spring. So in this case, it set up the spring, because typically this happens when the market's in a downtrend. They do this thing and then they spring and then go up. And that's what happened here. As it went up, right here, it hit a climax. So once remember, you want to think in terms of behaviors, and those behaviors are very, very critical. So the first most important behavior is what Wyckoff basically discussed as the first behavior in his course. And it is really the most important. I mean, it's called the climax. This is the first thing you want to learn, because this is what terminates a trend. Typically, this is what terminates the trend. And then after that, the automatic rally, which really is the change of behavior, that must be understood, because that creates the trend. So one to terminate, the other to create the downtrend. Terminate the uptrend, create the downtrend. So you have this, boom, boom, terminates the uptrend, creates the downtrend, confirms it, here's the springboard, and then it begins in earnest with the confirmation. So now, just take the short. It surprises me that this is that trends are actually systematic. I know folks that say this are all random, but it's not. They are systematic. There's too many examples that show the creation of trend with these behaviors. Too many. There are too many examples that show turning points. The only question is how far is the turning point going to go? How far, when the turning point is created, will there be a trend, and how far will it be? The chances are there will be a trend, but you don't know if it's a big trend or a little trend, or whether it's just short covering turning point that's going to get sold off. That you don't know, and there's no way to know it. Folks say, okay, let me get the point and figure out, and I think there is some validity to that. But mostly on a shorter term time frames or intraday, I mean, it's basically level to level. So, and you really have to have skill if you're going to combine that many behaviors and charts with this chart and that chart and indicators. It's a little bit much. All right. So at all times, you need to know a couple of things. What do you need to know? On the higher time frame, from the higher time frame, you need to know levels. Why? Because obviously those are areas where supply overtook demand and demand overtook supply, and those are always going to get tested. On a lower time frame, you also need to know where you are within those levels and looking for the behaviors, meaning the turning point behaviors. So you have to know the turning point behaviors of climax and all of that stuff to have an idea where it is that you are and where it is that you're likely to go. Right? And then when you combine the two, you'll see that there are always turning points at levels. It's just, I could give so many examples of that. I mean, take a look at this. This was, I don't even know where. Oh, yeah. Right there. It climaxed right into this level, which was the 30-minute ice, I think it is. Ice. I don't even know where I put it. Anyway, this is the break, right? The break and test. Breakdown of whatever it is, ice. And break and test. And as it tests, what do you see? Oh, lo and behold, a climax. You know? So a lot of time when it hit a level, it's going to climax into the level, terminating and then going the other way. And I'll show another example now. I think now. Climax, change of behavior, boom, 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 down. Continues to go down, continues to go down, continues to go down until it hits the same lower level right here. The low. So before it hit the what is that shit called? It hit the ice, breakdown and all of that shit, where it tested it, and then it went right back down to ice. And what did it do? This is a climax again. So if it's going into that level with climactic behavior, you don't 100% know that it's a climax. It could be a breakdown or breakout, right? Breakout to the downside right here. This could be a breakdown. But I say, like, I think for at least you'll have a clue. You'll have some type of clue, because it may be effort, it may be some other shit. But the idea here is, you see this, it's going into the level and then climaxing into the higher time frame level. When it does that, what happens? They find the whatever liquidity bullshit they want and go the other way. Why? Because this is short covering. Now, do you know whether this is short covering or the creation of a new trend? This is another problem. You don't. Because that's why you have to watch for the secondary tests. You have to watch for the secondary tests after the cover. So in this case, let's say you go down on a climax and then you rally on a change of behavior, right? Here, does this look like a low volume secondary test? No. This is not a low volume secondary test, it's high volume. There's a problem here. What's the problem? The problem is that this was short covering. This change of behavior was actually short covering because as this automatic rally or change of behavior occurs, it was sold. And if you know Wyckoff, you'll know that what he says, after the climax, you have that automatic rally, and one of the clues of whether it's going to trend or not, whether there's a turning point or not, is if that automatic rally is sold. If that automatic rally or that change of behavior is sold. So here you can see that it is sold right there. If you have automatic rally that's sold, that's not a secondary test. That's not a valid test. The valid test has to show lack of supply. So that is the first sign of a forecast of higher prices. If it was low volume here and it's holding, it would be the first sign of of higher prices to come, meaning you can forecast higher prices. Why? Because supply is gone. But in this case, this down move here has the biggest volume in 11 waves. So what does that mean? That means this is short covering and this is not set up for a high trend. Instead, it's being sold. And that's what happened. And compare this to this climax, automatic rally, secondary test, or climax, COB, and lack of demand. Is this being bought? No. Why? Look at the volume. Look at the volume. 35.3. So what does that mean? That means no demand, which means what? You're going to have lower prices. I'll give you another example. You hit a climax, you hit the change of behavior, now watch the first pullback. You're watching the pullback and you see this lack of volume, which means what? Sellers are not there. What are you comparing? You're comparing climactic volume to its secondary test after the change of behavior and knowing that it has completely diminished. Look at that versus that. 56 versus 8. So that means that if it makes a higher high, you're going to be set up for an uptrend. Now, yes, they will do springs and shakeouts and all of that to get you out before going up. But, what are you going to do? Sometimes those are there, sometimes they're not. So you just have to know. I'll give you another example here. Here, market goes up, and it hit a climax, right? Now you have a change of behavior here, right? Right there. Now when it goes up, this is a lot. This is a lot right here, right? 15. So I'm not trusting it, right? But then when it goes a little bit higher, you see, compare the 24 to the 7 and the 6, and that is telling you that demand is gone. These two are indications that the market is on the springboard to go lower. Why? Because this is not profit taking. If it was profit taking, like if this right here was profit taking, then demand would have shot up. It would have shot up and a continuation would have occurred. So here's another example. You have the climactic behavior, you have a change of behavior or automatic rally, and then you have this secondary test. What do you notice? If this was short covering, the volume here would not be so low. Automatic rallies will be sold off. Okay, again, short covering means that there's going to be a turn, there's going to be a bounce, but that bounce will get sold. Is this getting sold? Do you see 11 is less than the 96, 62, 20, 30, 22? Is this getting sold? No. So that's why climax, change of behavior, lack of demand, and your confirmation up here. And of course, there's going to be some shit right here that might do a spring, and in this case, it does a spring. And this will happen, especially when the turns are in downtrends. The market will pull back and has a tendency to do springs. I cannot do anything about that. So, how to detect that or anything like that. It's just you have to know from experience that chances are you're going to get whacked right there. And yeah, and when there's a downtrend, then the down turning points will not do an upthrust. Chances, they will do sometimes, but a lot of times they don't. They won't upthrust the high. Whereas in a downtrend, they will spring the low, but in downtrends, there's less likelihood of upthrust of the high because of the trend factor. Like here, it's a turn, but it gets whacked right here, spring, and then goes up. Okay, now you see the turn again, but does it take out the high? Does it upthrust the high? It doesn't. You know why? Because it's a downtrend. Downtrend will not, most of the times it will not upthrust the high, but it'll upthrust some middle area. So for example, this one right here upthrusted this this high, right? But doesn't upthrust the change of behavior high. And then it shit goes and goes and goes until it hits this. Okay, so what is the point that I'm trying to make here? There are a couple of points. The first is you want to think on a lower time frame from a Wyckoff standpoint, where the hell are you in the trend? Where are you in the trend? In the lower time frame, where are you in the trend? And in order for you to do that, you must mark and know where your change of behavior is, where your climaxes are, where's your confirmation. So you understand where you are in the trend and then trade with it by, whatever entry mechanism you use. Okay, from the higher time frame, you need to know where you are from level to level. Why? Because you have to combine both of them. From the higher time frame, you have to combine like, okay, this level here, level there, support, resistance, whatever. Then from the lower time frame, as you're going to those levels, you will have turns. When you have those turns, you have to be able to capitalize on them and connect that those turns are occurring at levels. So higher time frame levels plus lower time frame turning points. Where are you in that? Where are you in the level from from level to level? And from lower time frame, where are you in terms of the process of a change of trend or the creation of trend using the behaviors of climactic behavior, automatic rally, secondary test, also known as climax, change of behavior, and lack of demand or supply. So that's the key point. Now, the second point is when you're having a turn, the turn, it may be short covering or profit taking. So how do you detect, okay, this is a short covering and it's not a valid turn to go higher? It's not the creation of an uptrend, but instead it's just short covering and it will be sold. Well, that's because short covering is sold, so you must take a look at the secondary test, or the where you're supposed to get the lack of demand or lack of supply, or aka feathers weight. I don't know, there's a lot of terms for it. The secondary test, whatever. So you must see what happens after the automatic rally, also known as the change of behavior, to see how much pressure comes back. If it is very low volume, that is your first forecast. That is your first forecast of higher prices to come, which is confirmed by a higher high. If you do not, and instead you have heavy selling volume on the pullback after the automatic rally, that means you're going lower. Why? Because supply is still there and it's short covering, and the automatic rally or whatever was sold off.